This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone and welcome back. I'm Old Fish. Before we start, I want to address a quick correction. In my previous HHIS backtest video, I made an arithmetic error regarding the exchange rate adjustments. I have since pinned the corrected results in the comments of that video. Today's analysis will follow the fully revised methodology. My sincere apologies for the oversight. I've been debating for a long time whether or not to make today's video. As I record this, my heart is heavy. After my last backtest on HHIS, I received a lot of great feedback. Many of you were also asking me to look into HYLD. After all, it's often seen as the gold standard for Canadian income ETFs, having outperformed VSP for 2 years straight. I decided to run an exhaustive deep dive. But after reviewing the data from all of 2025, I've made a difficult choice. I am drastically reducing my position in HYLD, and I plan to exit most of my holdings over the coming weeks. I've praised its high yields before, but once I crunched the numbers line by line, the reality gave me chills. I realized that if I stay in, I might be sacrificing my principal to fund a complex financial game. On the surface, HYLD's performance looks flawless. Look at this year-end comparison. HYLD's total return was 23.47%. The S&P 500 hedged version, VSP, was only 16.87%. It beat the market by over 6 points. But is this performance as solid as it seems? To find out, I used testfall.io to reconstruct the actual underlying holdings. First, BMAX. Whether in HYLD 2.0 or the newer 3.0, its allocation is consistently over 60%. Then there is QMAX, always making up more than 25% of the weight. In my test, I started with $10,000 and covered the entirety of 2025. Crucially, since SMAX and QMAX rebalance their own portfolios semi-annually, I set my test frequency to match them exactly for a fair comparison. Also, to address a question from my last video, I have verified that Testfall already automatically includes dividends in the total return calculations, so these figures are all-inclusive. The results were staggering. If you simply held the underlying US blue chips for SMAX, the return was 36.42%. For QMAX, the theoretical return was a massive 42%. These two make up over 85% of HYLD. If you just held the stocks, your return should have been near 40%. Longtime viewers know I care deeply about the efficiency of covered call strategies. But to understand the numbers I'm about to show you, we need to clarify one thing. SMAX and QMAX are components of HYLD, and while HYLD is currency hedged and utilizes a 25% leverage, its underlying components are not. Therefore, to see how much these strategies actually contributed to the mother fund, we have to adjust their raw returns to match HYLD's structure. Let's look at SMAX and QMAX in 2025. SMAX delivered a total return of 14.31%. QMAX delivered 17.8%. In 2025, the Canadian dollar appreciated by about 5%. Since HYLD is hedged, it effectively neutralizes this currency drag. To calculate the theoretical contribution of these components, we first multiply their total return factor by 1.05, subtract 1 to get the currency-neutral return, and then apply HYLD's 25% leverage. Here is the math. For SMAX, 1.1431 times 1.05 minus 1, and then multiplied by 1.25 equals 25.03%. For QMAX, 1.1780 times 1.05 minus 1, and then multiplied by 1.25 equals 29.61%. Now, let's compare that to the simple unleveraged stocks. The SMAX underlying blue chips gained 36.42%. But even with the benefit of HYLD's leverage and hedging, the SMAX component only contributed 25.03%. The QMAX tech leaders gained 42%, but its leveraged contribution was only 29.61%. Friends, this is staggering. Even with the mother fund's 25% leverage and currency hedging, these strategies couldn't even get close to the naked underlying stocks. This is a massive loss of potential gains. I even tried to find excuses, maybe bad timing of rebalance or changing holdings. But as an actively managed fund, if your timing results in such a massive gap, it raises serious questions about management quality. I simulated other components too. For FMAX, the stocks returned 21.24%, but the ETF only gave you 7.84%. For EMAX, the stocks were up 9.24%, while the ETF managed only 4.26%. However, the case of AMAX proves that the covered call strategy can work. Even though AMAX contains a mix of US and Canadian stocks, let's look at what the leverage can do. If you just held the underlying stocks for AMAX, the return was 120.26%. but the actual ETF return was 106.35%. Even we ignore the adjustment of currency hedging, just apply the 25% leverage, the theoretical contribution reaches 132.9%, far surpassing the 120.26% return of the underlying stocks. Unlike the other funds, the BMAX data proves that the covered call strategy is capable of delivering high returns and outperforming the market. So, this leaves me with a difficult question. If the covered call strategy is shown to be effective for BMAX, why is there such a massive discrepancy with all the other funds? It suggests that the low performance in the other ETFs might not be a limitation of the strategy itself, but rather a result of how those specific funds are being managed. This leads to a curious observation. HYLD mirrors the SP 500 with remarkable precision. Is it possible that the performance of SMAX and QMAX is being managed specifically to maintain this tight correlation with the index? And does this explain why, even with the addition of QDAY and SDAY, which only make up a combined 10%, the vast majority of the portfolio is still locked into the precisely controlled SMAX and QMAX? I don't have all the answers, but the patterns are hard to ignore. So, I've made a difficult decision. I will be significantly reducing my HYLD position, and in the coming weeks, I expect to liquidate most of it. But to be honest, I haven't quite figured out where to move the capital yet. If I switch to USCL, I'm concerned about the continued risk of US dollar depreciation. That 25% leverage only amplifies the currency risk, and a 50% covered call coverage is a bit higher than I'd like. The reality in Canada is different from the US. For a pure S&P 500 covered call ETF, your only real options are USCL or the unleveraged ESPX. To be fair, ESPX is a solid choice, but it lacks built-in leverage. I even thought about using my own margin account to create that 25% exposure myself, but after thinking it through, I don't want to shift that risk directly onto my own shoulders. In my opinion, Evolve should really consider launching a 25% leveraged version of ESPX. Instead of launching products like SIXI, which just competes with their own bank ETF, a leveraged ESPX could actually steal market share from Global X's USCL and Hamilton's HYLD. I am curious, what would everyone do in this situation? Please let me know your thoughts in the comments. I'd love to hear your perspective. I know this video might stir up some debate, but before I am a content creator, I am an investor. Just like you, I have my own money in these funds. If I see these patterns and stay silent, I'm not being true to the mission of this channel. I'm sharing this so you can stay informed. If there are any errors in my analysis, please point them out. To be honest, I hope I've misunderstood Hamilton more than anyone else does. I hope this deep dive helps you navigate your own path. If you found this helpful, please like, comment, and subscribe. Thanks for watching, and I'll see you in the next one.